1. Educate yourself. Before investing in the stock market, it's important to have a good understanding of how it works, the different types of investments such as stocks, bonds, mutual funds, real estate, etc., and the associated risks involved with each. Take the time to read books, articles, and take online courses to educate yourself about the market. Lastly, you may want to seek advice from folks that are experienced investors. 2. Set realistic expectations. The stock market can be volatile, so it's important to set realistic expectations for your investments. Have a good understanding of your goals prior to making the investments and your exit strategy if goals are achieved or the investment is no longer consistent with your overall goals. Don't expect to make a fortune overnight and be prepared for potential losses. Even the most savvy investors experience losses from time to time. 3. Diversification. One of the most important rules of investing is to diversify your portfolio. Don't put all your eggs in one basket and spread your investments across different sectors, industries and asset classes. This is a smart strategy because when one sector or asset class is underperforming, you can offset the poor performance by the other investments that are performing well. Understanding your goals will also help you determine how to diversify your portfolio. For example, if the investments are for retirement and you have 30 years before you retire, then you can pick more aggressive investments. Conversely, if the funds will be needed sooner, you would want to invest more conservatively. 4. Invest for the long term. The stock market is not a get-rich-quick scheme, so it's important to invest with a long-term mindset. Stocks will typically fluctuate up and down in the short term but tend to show positive results in the long term. A long-term investment is a purchase of a stock that you hold onto for at least a year. Focus on quality companies with strong fundamentals and a positive future outlook and hold on to your investments.
5. Don't try to time the market. Trying to time the market is a risky strategy, and it's not a good idea for most investors. Timing the market means attempting to guess the lowest point to buy a stock and the highest point to sell a stock. Even the most experienced investors have difficulty timing the market. Instead, focus on buying quality companies at reasonable prices and holding on to them for the long term. 6. Keep emotions in check. The stock market can be emotional, so it's important to control your emotions. Don't get too excited when the stock market rises or too down when the market falls. Don't make decisions based on fear or greed and stick to your investment plan. It's also not a good idea to constantly monitor your portfolio multiple times a day because that can lead to unnecessary stress and panic. If you have a sound long-term strategy, you can weather the market fluctuations. 7. Consider hiring a professional. If you're new to investing or don't have the time or expertise to manage your own portfolio, consider working with a professional financial advisor who can help you create a customized investment plan. There is typically a cost associated with hiring a professional, but it can be well worth the cost.